Something has shifted. If you've been watching the silver market over the past few weeks, you've likely noticed the volatility, the headlines, the sudden surge in attention from corners of the financial world that typically ignore precious metals altogether. This isn't your typical seasonal movement. This isn't just another Reddit rally or social media squeeze that evaporates within days. What we're witnessing is the intersection of several powerful macroeconomic forces colliding at once, forces that have been building quietly beneath the surface for years. And silver, often overlooked in favor of its more prestigious cousin gold, has suddenly found itself at the center of a conversation that every thoughtful investor needs to understand. Let me be clear about something from the start. This video is not about telling you to buy or sell anything. It's not about hyping an investment or creating fear. If you're looking for someone to promise you that silver is going to a specific price by a specific date, you won't find that here. Instead, what I want to do is walk you through what's actually happening in the silver market right now, why it's happening, what the historical context tells us, and most importantly, how to think about this moment whether you already own silver or whether you're considering it for the first time. Because here's what matters. Understanding the underlying dynamics of any market is always more valuable than reacting to the noise. And right now, there's a lot of noise, so let's cut through it together. To understand what's happening with silver today, we need to start with a simple observation. Something fundamental has changed in how the market is behaving. For years, silver has traded in a relatively predictable pattern. It would rise with inflation concerns, fall when the dollar strengthened, track gold's movements with higher volatility, and generally remain in the background of most serious portfolio discussions. It was the metal that industrial manufacturers needed, that photographers once used, that collectors enjoyed, but that institutional investors largely ignored. That dynamic is shifting. Over the past several months, we've seen silver prices move in ways that suggest more than just industrial demand or inflation hedging. We're seeing supply constraints become a serious topic of conversation. We're seeing physical premiums, the amount you pay above spot price for actual metal, widen significantly in many markets. We're seeing delivery delays and inventory drawdowns at major exchanges. But more importantly, we're seeing a change in sentiment among a specific group. Serious money managers who study currency debasement, debt sustainability, and long-term purchasing power preservation. These aren't speculators looking for a quick trade. These are the people who think in decades, not days. And when this type of capital begins repositioning toward an asset that's been neglected for years, it creates conditions that can persist far longer than most people expect. The question is, why now? What has triggered this shift after years of relative calm? The answer lies in understanding what's happening at the macro level. Forces much larger than silver itself. Let's talk about the environment we're operating in. Global debt has reached levels that would have been unthinkable a generation ago. Government debt, corporate debt, household debt, all expanding at rates that outpace economic growth. This isn't a moral judgment, it's simply mathematical reality. When debt grows faster than the economy's ability to service it through productive activity, something eventually has to give. Historically, that something has taken different forms. Sometimes it's default, sometimes it's austerity. But most often in modern economies with fiat currency systems, it's currency debasement, the gradual erosion of purchasing power through monetary expansion. We've seen this acceleration dramatically since 2020. Central banks around the world expanded their balance sheets at unprecedented rates. Money supply growth surged, and while inflation initially seemed transient, remember that term? It proved far stickier than authorities anticipated. Now we're in a complex situation. Inflation remains elevated in many categories that matter to ordinary people: food, energy, housing, insurance. Yet economic growth is fragile. Employment data shows cracks. Consumer spending, while still positive in headline numbers, increasingly relies on credit rather than rising real wages. This creates a dilemma for monetary authorities. Raise rates too much, and you risk recession and debt servicing crises. Keep rates too low or cut too quickly, and you risk reigniting inflation expectations and further currency weakness. It's in this environment, this uncomfortable middle ground, that precious metals tend to attract serious attention. Gold has already responded. It's been making new highs, surprising many analysts who expected it to fall as rates stayed elevated. But gold's movements are now well documented, well discussed. Institutional ownership is significant. Central banks are steady buyers. Silver, however, has been different. It's remained more volatile, less institutionally owned, more tightly supplied in physical form, and far more leveraged to industrial demand in an economy that's simultaneously trying to electrify and digitize everything. Here's where things get interesting, and where many investors, even experienced ones, often get confused. Silver occupies a unique position in financial markets. It's neither purely an industrial metal nor purely a monetary one. It's both simultaneously, which means it responds to different forces at different times. When investors think precious metal, they often think of it like gold, a store of value, an inflation hedge, something you buy and hold as insurance, and silver can serve that function. But it's also deeply embedded in industrial applications that are growing: solar panels, electronics, electric vehicles, 5G infrastructure, medical devices. This dual nature means silver can move for completely different reasons at different times. Sometimes it's tracking gold, responding to currency concerns. Other times, it's responding to industrial demand outlook. And occasionally, when conditions align, it responds to both simultaneously, which creates the kind of price volatility we're seeing now. Most investors also dramatically underestimate the supply-side dynamics of silver. Unlike gold, which is primarily mined for its own sake, roughly 70% of silver comes as a byproduct of mining other metals: zinc, lead, copper. This means silver supply doesn't respond quickly to price increases the way a primary metal's supply might. You can't just turn on more silver production when prices rise if the economics of copper or zinc mining don't support it. Additionally, above-ground stockpiles of silver available for investment have been declining for years. Much of the silver mined goes directly into industrial applications, where it's not economically recoverable. It gets used up. This is different from gold, where nearly all the gold ever mined still exists in some form, whether in jewelry, bars, or vaults. The market structure itself adds another layer most people don't see. The paper market for silver, futures, options, and derivatives, is enormous relative to the physical market. This creates situations where price discovery happens in the futures market, but physical delivery can be constrained, leading to disconnects between paper prices and what you actually pay for metal in hand. Understanding these nuances matters because it explains why silver can seem cheap relative to gold for years, then suddenly move violently when the right conditions emerge. Let's step back and look at how silver has behaved during similar periods in the past. If we examine the 1970s, an era of currency instability, rising inflation, and loss of confidence in monetary authorities, silver moved from around $1.50 per ounce to a peak near $50. This wasn't a straight line. It was volatile, with significant corrections along the way. But the underlying trend was driven by fundamental concerns about currency purchasing power. The late 2000s and early 2010s provide another case study. Following the 2008 financial crisis, as central banks embarked on unprecedented monetary expansion through quantitative easing, silver moved from around $9 per ounce in 2008 to nearly $50 in 2011. Again, extreme volatility characterized the move, and many investors who bought at the peak suffered significant losses when the correction came. What do these historical episodes teach us? First, silver's major moves tend to coincide with periods of monetary uncertainty and expanding liquidity. When faith in currency stability weakens, when central banks are actively expanding money supply, when real interest rates, the rate after inflation, are low or negative, silver tends to attract attention. Second, these moves are rarely smooth. Silver doesn't go up a little bit every day. It tends to move in bursts, with violent corrections that shake out weak hands. The volatility itself becomes part of the story. Third, and this is crucial, the moves tend to last longer than most people expect when they begin, but end more abruptly than most people anticipate. This creates a pattern where investors dismiss the early stages, chase the middle stages, and get caught in the late stages. The key insight from history isn't that silver always goes up or always makes people wealthy. It's that silver responds to specific conditions, and when those conditions are present, the asset behaves in characteristic ways that disciplined investors can understand and prepare for. Right now, many of those historical conditions are present again: expanding deficits, currency concerns, negative real yields in many markets, geopolitical tension, and supply constraints meeting growing industrial demand. Now let's talk about something concrete, what's actually happening with physical silver right now. Global silver production has been essentially flat for several years despite higher prices. Remember what we discussed: most silver comes as a byproduct, so production doesn't respond quickly to silver's price alone. Meanwhile, demand from industrial applications continues growing, particularly in the solar sector, which has become a major consumer. Investment demand, after years of being relatively quiet, has started increasing. Exchange-traded funds that hold physical silver saw inflows in recent months. Sovereign mints report strong sales. Dealers indicate their inventory levels are tighter than they've been in years. What's particularly interesting is the development in certain Asian markets, where both investment and industrial demand are rising simultaneously. These markets, with their different cultural attitudes toward precious metals and their massive manufacturing bases, represent a structural shift in where silver demand is coming from. On the supply side, we're not seeing significant new primary silver mine development. Projects take years to bring online, require substantial capital investment, and face increasing regulatory and environmental challenges. The easy-to-mine deposits were found decades ago. Recycling provides some supply, but unlike gold, much industrial silver use is in such small quantities per application that recycling isn't economically viable. Once silver goes into a solar panel or an electronic circuit board, it's essentially gone from the supply chain. This creates a situation where the market is depending on above-ground stockpiles and existing mine production to meet growing demand. When those stockpiles decline, as they have been, the market becomes more sensitive to any surge in demand, whether industrial or investment. Now, does this mean silver must go up in price? No. Markets don't work on must. They work on probability and conditions. But it does mean the conditions exist for significant price volatility and potential appreciation if investment demand continues increasing while supply remains constrained. If you're someone who already holds silver, whether you bought it years ago or more recently, this moment requires careful thinking, not emotional reaction. The first thing to understand is this: volatility works both ways. If you've enjoyed watching silver appreciate recently, you also need to be mentally prepared for sharp corrections. They're not just possible, they're likely. This is how silver behaves. Anyone who tells you differently doesn't understand the asset. Your positioning right now should depend entirely on why you bought silver in the first place. If you bought it as a long-term hedge against currency debasement, as a store of value over decades, then short-term price movements, up or down, shouldn't materially change your strategy. You're not trading. You're preserving wealth across time horizons measured in years, not weeks. If you bought silver because you understood the supply-demand dynamics and believed they favored appreciation over time, then recent price action might be validating your thesis. But validation is not the same as certainty. Markets can remain irrational or move against fundamental reality for longer than seems reasonable. The question becomes, has anything changed fundamentally? Are the conditions that led to your original analysis still present? Here's what you shouldn't do. Don't let recent gains make you complacent or greedy. Don't suddenly decide to lever up your position with borrowed money because you know it's going higher. Don't start telling everyone they need to buy silver immediately. These behaviors indicate emotional decision-making, not rational analysis. Consider whether your current allocation still makes sense for your overall financial situation. Maybe silver has appreciated enough that it now represents a larger percentage of your portfolio than you intended. That might warrant rebalancing, taking some profits, ensuring you maintain the diversification that protects you against being wrong. Or perhaps your allocation is still appropriate. And the right move is simply to hold, to remain patient, to recognize that if the underlying thesis is correct, this story likely has years to play out, not weeks. The key principle is this: respect the volatility, maintain your discipline, and don't let short-term price action, in either direction, cause you to abandon a well-reasoned long-term strategy. If you don't currently own silver, but you're considering it, this environment requires even more careful thought. The worst thing you can do is make an emotional decision based on fear of missing out. When assets move quickly and attention increases, the psychological pull to jump in becomes powerful. This is precisely when many investors make their worst decisions, buying at temporary peaks, out of emotion rather than analysis. Before considering any allocation to silver, you need to ask yourself honest questions. First, do you understand what you'd be buying? Not what some YouTube personality says about it, not what someone on social media promises, but do you genuinely understand silver's role in a portfolio, its volatility, its historical behavior? Second, what problem are you trying to solve? Are you concerned about currency purchasing power over long time horizons? Are you looking for portfolio diversification away from traditional financial assets? Are you speculating on industrial demand growth? Your answer should drive your approach and position size. Third, can you afford to be patient, and can you emotionally handle volatility? If you're going to panic and sell the first time silver drops 15% in a week, and it can and does, then you probably shouldn't own it. Volatility is not the same as risk if you have a long time horizon, but it feels like risk in the moment, and human psychology struggles with that. If, after honest reflection, you believe silver has a place in your portfolio, the approach should be measured and systematic. This might mean dollar cost averaging into a position over time, rather than making a single large purchase at potentially elevated prices. It might mean starting with a smaller allocation than you eventually want, and allowing yourself to learn how the asset behaves before committing more capital. It absolutely means educating yourself properly. Understand the difference between paper silver and physical silver. Understand storage considerations. Understand transaction costs and premiums. Understand that precious metals don't generate yield or dividends. Their purpose is wealth preservation, not income generation. And here's the crucial point. If you do choose to allocate to silver, do so as part of a broader, diversified strategy. Silver is not a replacement for emergency savings. It's not a replacement for retirement accounts. It's not something you bet your financial future on. It's a component, one tool among many, that serves a specific purpose within a thoughtful overall plan. Let's talk explicitly about the mistakes you need to avoid, because in markets like this, emotional errors destroy more wealth than incorrect analysis. First, do not over-leverage. The temptation to use borrowed money, to trade futures or options with significant leverage, to bet more than you can afford to lose, this temptation increases when assets are moving. Resist it completely. Leverage magnifies gains, but it also magnifies losses. And in a volatile asset like silver, leverage can wipe you out even if you're ultimately right about direction. Many investors who were correct about silver's long-term trajectory still lost everything because they used too much leverage and got caught in a correction. Second, do not chase headlines or social media narratives. The internet is full of people making extraordinary claims about silver, manipulation theories, guaranteed price targets, can't lose scenarios. Some of these narratives contain elements of truth. Most are exaggerations or misunderstandings. None of them should be the basis for your financial decisions. Do your own research, understand the fundamentals, think independently. Third, do not ignore the rest of your financial life. Sometimes, when people become convinced of a particular investment thesis, they start neglecting everything else. They stop contributing to retirement accounts. They ignore high-interest debt. They abandon diversification. This is dangerous. No single asset, no matter how promising, should dominate your financial decision-making to the exclusion of basic financial health. Fourth, do not make decisions based on fear or greed. These are the two emotions that drive most investment mistakes. Fear makes you sell at bottoms. Greed makes you buy at tops. Both make you abandon rational analysis in favor of emotional reaction. Markets prey on these emotions systematically. Your job is to recognize when you're feeling them and step back until you can think clearly. Fifth, do not assume that understanding one aspect of the market makes you an expert in all aspects. You might understand macroeconomics well, but not understand silver's industrial demand. You might understand technical chart patterns, but not understand supply dynamics. Intellectual humility matters. The most dangerous investor is the one who knows just enough to be confident, but not enough to be truly informed. Finally, do not forget taxes, transaction costs, and storage realities. Physical silver has premium costs when you buy, and bid-ask spreads when you sell. It requires secure storage. Profits are typically taxed as collectibles in many jurisdictions, often at higher rates than long-term capital gains. These practical realities matter and need to be factored into any decision. The common thread in all these warnings is this: protect yourself from yourself. The biggest risk in any investment, particularly in volatile ones during periods of high attention, is your own psychological response. Understanding crowd psychology and market cycles is as important as understanding fundamentals, perhaps more so in the short to medium term. Markets move in cycles driven by human emotion. This isn't a flaw, it's a feature. Fear and greed, pessimism and optimism, these swing like a pendulum, and price movements often reflect these emotional shifts more than immediate fundamental changes. Silver, because of its smaller market size and dual nature, tends to experience these emotional swings more dramatically than larger, more established markets. This creates opportunity, but also risk. In the early stages of a move higher, most investors ignore it. The price increases seem small, unconvincing. The narrative hasn't formed yet. This is actually when risk-reward is often most favorable, but it's also when conviction is hardest to maintain because you're early and potentially alone in your thinking. As the move continues, more people notice. Stories start appearing. The narrative builds. This is where many investors first get interested, not at the beginning, but after the move is already substantial. This middle phase can last surprisingly long, and it's where people who bought early start to feel validated. Then comes the late stage. This is where emotion overwhelms analysis. Everyone is talking about it. Your neighbor, your coworker, people who never discussed investing before suddenly have strong opinions. Valuations seem irrelevant. The narrative becomes extreme. This time is different. The sky is the limit. Anyone who doesn't participate is foolish. This late stage emotional peak is where the most money typically gets committed and where the biggest losses are ultimately realized, because what follows is correction. Sometimes orderly, sometimes violent, but inevitable. Prices that went up dramatically come down dramatically. Weak hands panic sell, the cycle repeats. Where is silver now in this cycle? That's the question every investor is trying to answer. Has the emotional peak occurred? Or are we still in the early to middle phase with room to run? Honest answer, nobody knows for certain. Anyone who claims certainty is either lying or deluded. What we can observe is this. Attention is increasing, but hasn't reached bubble levels. Mainstream financial media covers silver, but it's not the dominant story. Retail investors are getting interested, but institutional participation remains limited. These observations suggest we're not at an emotional peak, but they don't guarantee further appreciation. The point isn't to perfectly time the cycle. The point is to recognize which phase exists and adjust your behavior accordingly. Be more cautious when emotions are extreme. Be more thoughtful when the narrative overwhelms the fundamentals. And always maintain the perspective that cycles turn, often when least expected. Silver doesn't exist in isolation. To understand what's happening, you need to understand the broader financial environment. We're living through a period of profound transition in the global monetary system. The post-World War II order, built on dollar dominance and relatively stable debt levels, has evolved into something quite different. Debt is now the primary feature of the system, not a bug. Growth depends increasingly on credit expansion rather than productivity improvements. This creates inherent instability. Systems built on exponentially growing debt eventually face mathematical limits. We may not be at that limit today, but we're closer than we were a decade ago, and certainly closer than we were 2 decades ago. Central banks face an impossible trilemma: maintain currency stability, support economic growth, and service massive debt loads. You can maybe achieve 2 of these simultaneously. Achieving all 3 seems increasingly unlikely. This is why hard assets, tangible things with no counterparty risk, attract attention during these periods. It's not speculation, it's rational concern about the long-term stability of purely financial assets, whose value depends entirely on confidence in institutions and currencies. Silver, as a monetary metal with industrial uses, becomes interesting in this context. It's not just a bet on inflation. It's a recognition that having some portion of wealth in forms that exist independent of the financial system might be prudent. But, and this is important, this doesn't mean abandoning the financial system entirely or betting everything on precious metals. The system is remarkably resilient. Authorities have powerful tools. Innovation continues. Productivity improvements happen. Collapse narratives are usually wrong in their timing and often wrong in their extremity. The appropriate response isn't panic or extremism. It's prudent diversification. It's recognizing that the future is uncertain and positioning yourself to survive and potentially thrive under multiple different scenarios, not just the one you think is most likely. One of the most important mental shifts any investor can make is moving from thinking in certainties to thinking in probabilities. Nothing in financial markets is certain. The future is not predetermined. Even seemingly obvious trends can reverse. Even compelling fundamentals can be overwhelmed by other factors you didn't anticipate. Certainty is an illusion that creates vulnerability. Probabilistic thinking means asking different questions. Not, will silver go up? But, what's the probability that silver appreciates significantly from here, given what I know? Not, is the dollar going to collapse? But what's the probability of continued dollar weakness relative to hard assets over the next several years? When you think probabilistically, your decisions change. You don't put all your capital into the highest conviction idea because you recognize there's still meaningful probability you're wrong. You size positions based on probability and potential outcomes. You maintain diversification because even low probability events occur, and you need to survive them. This framework also helps with emotional control. When you think in certainties and markets move against you, it creates cognitive dissonance. You were certain, and now you're losing money. This often leads to either doubling down irrationally or abandoning this position at the worst time. When you think probabilistically and markets move against you, it's less jarring. You never expected certainty. You assigned a probability. Sometimes lower probability outcomes occur. That's normal. It doesn't mean your analysis was wrong. It means you're operating in an uncertain world and managing that uncertainty appropriately. For silver specifically, probabilistic thinking might sound like this. Given current monetary conditions, supply constraints, and industrial demand trends, I believe there's a reasonably high probability silver appreciates significantly over the next few years. However, I also recognize meaningful probability of continued volatility, interim corrections, or factors I haven't considered that could lead to different outcomes. Therefore, I'll allocate X% of my portfolio, an amount I can hold through volatility and that won't devastate me if I'm wrong. This is so different from silver is definitely going to $100. I'm putting half my net worth in, and anyone who disagrees is an idiot. One of these approaches leads to sustainable, rational investing. The other leads to eventual disaster. So where does this leave us? What should you actually do with all this information? The answer depends entirely on your individual circumstances, but the framework should be consistent. Discipline and education matter more than timing or prediction. Discipline means having a plan and sticking to it. It means defining in advance what you'll do under different scenarios. If silver drops 20% from here, what will you do? If it rises 50%, what will you do? Having these answers before the emotion of the moment is crucial. Discipline means maintaining your allocation strategy even when it feels uncomfortable. When silver is dropping and everyone is pessimistic, maintaining your position requires discipline. When silver is soaring and everyone is euphoric, not over-allocating requires discipline. Education means continuously improving your understanding. Read the supply and demand reports from industry organizations, study historical price cycles, understand the different factors that drive silver in different environments, learn about the distinction between monetary and industrial demand, know how exchange-traded funds work versus physical ownership. The investors who succeed over long time horizons are not necessarily the smartest or the ones with the best predictions. They're the ones who remain rational when others are emotional, who continue learning when others assume they know everything, who maintain perspective when others get lost in short-term noise. This applies whether you're a current silver holder or someone considering it. Your job is not to be right about the next week or month. Your job is to build and maintain a portfolio that protects your wealth over years and decades through multiple different market environments, most of which you can't predict in advance. Silver may have a role in that portfolio. It may not. But that determination should come from honest self-assessment and education, not from fear of missing out or predictions about imminent crises. One more critical point: stay humble. Markets have a way of humbling everyone eventually. The person who thinks they've figured it all out is usually about to learn an expensive lesson. Intellectual humility, recognizing the limits of your knowledge, remaining open to being wrong, adjusting when new information arrives. This is not weakness, it's wisdom. As we close, I want to leave you with some perspective that applies regardless of whether silver continues rising, corrects, or does something unexpected. Financial markets are not the most important thing in your life. Your relationships, your health, your purpose, your peace of mind, these matter far more than your investment returns. Yes, financial security enables other aspects of a good life, but it's a means, not the end itself. Don't let investment decisions, whether about silver or anything else, consume you to the point where they damage what actually matters. Don't let portfolio gains make you arrogant. Don't let portfolio losses make you depressed. Maintain perspective. The current situation with silver is interesting. It may be important. It likely reflects larger forces in the global economy that everyone should understand. But it's not the only thing happening, and it's certainly not the only thing that matters. If you choose to own silver, do so as part of a thoughtful, diversified approach to preserving and growing wealth. If you choose not to own silver, make that decision based on your own analysis, not on dismissing others or assuming you know better. Both positions can be rational depending on individual circumstances. What's not rational is emotional decision-making, whether driven by fear or greed. What's not rational is abandoning basic financial principles because of conviction in any single asset. What's not rational is letting short-term market movements dictate your long-term strategy. The title of this video mentions a crisis and markets on fire. These words capture attention, and there's truth to the fact that significant changes are occurring. But crisis and opportunity often coincide. The Chinese word for crisis supposedly combines the characters for danger and opportunity. That may be apocryphal etymology, but the concept is sound. Yes, there are dangers in current markets, there are dangers in holding any asset, there are dangers in the macroeconomic environment, but there are also opportunities for those who remain rational, educated, and disciplined. Silver is experiencing unusual volatility and attention right now because multiple factors are aligning: supply constraints, industrial demand growth, monetary uncertainty, and shifting investor psychology. Whether this moment represents the beginning of a sustained move or a temporary spike is unknowable. What we can know is this: the underlying conditions that are driving attention to silver, concerns about currency stability, debt sustainability, and the search for alternatives to purely financial assets. These conditions remain in place and likely strengthen over time. For current holders, the message is clear: maintain your discipline, respect volatility, and don't let short-term price action dictate long-term strategy. For those considering silver, the message is equally clear: educate yourself properly, size positions appropriately, and never make decisions based on emotion or fear of missing out. The broader lesson transcends silver. In a world of increasing economic and monetary uncertainty, having a thoughtful approach to wealth preservation matters more than trying to perfectly time any single asset. Diversification, education, emotional control, and long-term thinking will serve you better than predictions, leverage, or following crowds. Understanding cycles matters more than fighting them. Understanding your own psychology matters more than understanding markets. And understanding that wealth is ultimately a tool for living a good life matters more than the wealth itself. Thank you for investing your time in this analysis. Stay informed, stay rational, and most importantly, stay true to your own financial principles, even when markets become emotional. That's how thoughtful investors navigate uncertainty, not by predicting the future, but by preparing for multiple futures and maintaining the flexibility to adapt as conditions evolve. The silver market will continue to fluctuate. Headlines will continue to create noise, but your job remains constant. Think clearly, act deliberately, and never let market hysteria replace careful analysis. Until next time, take care of your financial health, and remember that preparation beats prediction every single time.